Hello and welcome to Pro Trader Strategies Market Commentary for Tuesday, December the 15th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're trying to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios. Therefore, what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. We have had some economic data come out today in the form of CPI, which is Consumer Price Index. Across the pond, it came in line with expectations. Great Britain's Producer Price Index was quite a bit lower than expected. And here in the United States, core and regular CPI came in line with expectations, showing that there's really not a lot of inflation out there whatsoever. And that leads me to believe that the Fed should not go. Anytime there's not any inflation, we're actually looking at a deflationary type of scenario here. And we're talking about historic times here. The Fed raising, going into a holiday season, trying to crimp the consumer spending there. And we have deflationary things going on in the overall market. No inflation whatsoever. So, we'll have to see. They're just probably going to do it to justify their jobs, as far as I can tell at this point. Anyway, moving on to the markets. The overall market has popped back after yesterday's big rally back. It was looking pretty dismal early on, and then we've rallied back and then popped through the value area high of the NASDAQ here. NASDAQ is the leading equity market right now. As you can see here, this is a 15-minute chart of the E-mini S&Ps, and very close to the highs of the day, up about 28 points, and looking to come into the value area of the last several days here. So the overall markets are looking pretty robust going into this Fed meeting. A couple of trades that I've done. One I've taken off, and I've added 3 to my position. Took off this UAL. Was looking a lot better yesterday, and this was one along with Apple that I was kind of chasing throughout the day. Came down to this area and started rallying back. This is when it was looking its best, obviously, because I was long a put spread. But came back in and just wanted to take some things off the table here going into tomorrow's meeting and get relatively flat in my portfolio in regards to deltas. I'm actually a little bit long deltas now, just from some of the things that I put on today. But in UAL, I had on the January 57.5, 52.5 put spread, and I had originally done it for a debit of $1.30 and sold it out for $1.43. So not a huge winner there, but winner nonetheless. That was another thing. I didn't want to see that thing rally up here, and it's kind of in this little bit of a range, and if it rallies up here, I'm going to look to probably put that trade back on. Also, since we've had this bit of a sell-off, we've seen this implied volatility go up, and it's starting to come off a little bit. That's another reason why with these debit spreads, I didn't want to see me lose any of that volatility. So as volatility goes down, debit spreads start losing a little bit more money, and we are also in that time frame where we get theta decay. So that's why I took off a lot of those debit spreads. I might re-establish those debit spreads. Like I said, volatility comes out in the further duration option series, right? Halliburton I did because we're really in this range here, and I might even make this into an iron condor. If we get it to pop up here, I might start selling a call spread or something. But I did a put spread in here, debit put spread in January. I bought the 35, sold the 36 put spread, and did it for 31-cent credit. So I bought the 35s down here and sold the 36s, the 35s are to define my risk. So if it goes much below this area, this is the Fibonacci levels. I drew in this line because that's acting as a support here as well. So right in between those two. So that's why I put on those 36s. That's why I sold the 36s there. In USB, if the Fed does raise rates, the banks are going to do pretty good. The financial sector is going to do rather well. So just on the probabilities of them raising rates are well over 50% that they're going to raise rates at this meeting, probably just a quarter basis point. That is going to help banks in the lending aspect, so they'll be able to make a little bit more money off of interest rates. So I did the January 42.43 put spread and sold it for actually 32 cents. And so, if they do raise rates, this is going to at least come up and test this resistance area. And as you can tell, we have pretty high implied volatility. If the volatility starts coming out when the market starts rallying, that will help me out with that spread as well. On to ADM. I put on ADM because ADM is been really beaten up. As you can tell here, it's come down. I mean, if we look at it on a weekly chart, you can tell it is at this 76 retracement. It hasn't been down this low really since 2013 for the most part, early 13. And it's made the top here coming into this year, and it's been in a bear market for the better part of the year. But I am looking for it to find a little bit of support here and push a little higher. So in ADM, I did the January 33.34 put spread and sold that for 31 cent credit. So, it came down. This is a pretty tight one. So, this is putting risk on the table for this one, and sold the 34s to hopefully stay above today's low or this week's low, and then push a little bit higher and at least come up and test this resistance area. I'll probably look to take that off. As you can see, volatility again coming off in ADM. So those are all the trades that I've done today. This week's webinar is going to be on collars, and it's going to be using collars to replace the stops because the NYSE is getting rid of stop orders. Last week we did a webinar on the puts and using puts to replace stops. This week we're going to be doing it on a collar, which is buying a put and then selling a call a little bit higher. So if you are one of the traders that has puts in there all the time, and then maybe a limit order a little bit higher, if you reach that, you want to get out, this is going to be the perfect strategy for you because we can use that call to finance that put and put on those strategies for a lot less money. The puts are a little bit a cost intensive type thing because you're laying out money. It increases your cost basis. This is going to be a way to neutralize that increase in cost basis. So we hopefully can do that for relatively little outlay of money, so our basis doesn't increase that much. All right, so that should be a really good one. That's all I got for you guys today. Check out Friday's webinar. Also, I did that roundtable discussion yesterday with timing research, and you can check that out too. All right, if you can't take that, take it easy.